You don't need to memorize names like Doji, hammer, or engulfing. What you do need is to understand how a candle forms and what it means. Because every candlestick tells a story. It's a visual representation of buying and selling, strength and weakness. In other words, a reflection of human behavior, emotion, and decision-making. So what is candlestick? A candlestick is a way of displaying price movement on a chart. It doesn't just show you where price is now, it shows you how it moved during a specific time period, meaning the time it takes for one candle to form, like 5 minutes, 1 hour, or even an entire day. If you've only looked at line charts, you'll notice they connect closing prices with a simple line. That can be helpful, but it leaves out a lot of detail. A candlestick gives you the full picture. It shows the open, the high, the low, and the close for that period. With that extra detail, you can see not only the end result, but also the struggle between buyers and sellers along the way. Before you can read what a candlestick is saying, you first need to understand what builds it. Every candlestick comes from 4 key prices. The open marks the price when the candle starts forming. The close marks the price when it finishes. The high shows the highest point price reached during that period, and the low shows the lowest point it touched. Now, let's look at the thick part in the middle. This is called the body. The body measures the distance between the open and the close. If price rises from the open and closes higher, the candle turns green. That green color tells you buyers had the upper hand. They pushed price up and held it there until the candle closed. On the other hand, if price drops from the open and closes lower, the candle turns red. That red shows sellers were stronger. They drove price down and kept it there until the period ended. In short, green means buyers won that round, while red means sellers took control. Next, pay attention to the size of the body. A large green candle signals strong buying momentum. Buyers dominated from start to finish. A small green candle still means buyers won, but the fight was tighter, with hesitation or low volume. The same principle works for red candles. A big red candle means heavy selling pressure, with sellers pushing price down hard. A small red candle shows sellers still had control, but their win wasn't as decisive. Finally, let's talk about the wicks or shadows, the thin lines above and below the body. They reveal where price moved but couldn't stay. In a bullish candle, the top wick forms when buyers push price higher, but sellers step in and force it back down before the close. The bottom wick forms when sellers push price lower, but buyers fight back and lift it before the candle finishes. In a bearish candle, it's the opposite. The top wick forms when buyers try to push price higher, but sellers overpower them and pull it down. The bottom wick forms when sellers drive the price lower, but buyers manage to push it back up slightly before the close. So every candlestick is a small battle on the chart. The body shows who won, the wicks reveal the back and forth, and the size tells you how decisive that win really was. Now that you know how a candlestick forms, the next step is to see how it behaves across different time frames. This step is crucial for beginners because the same price move can look completely different depending on which time frame you use. Think of it like zooming in and out on a picture. When you zoom in, you notice every tiny detail. When you zoom out, you see the bigger story, but lose those small movements. Candlestick charts work the same way. Take a 5-minute candle, for example. On the 5-minute chart, you might see one big green candle showing strong buying. But if you switch to the 1-minute chart, that same candle actually breaks down into 5 smaller candles. The chart reveals all the little swings, 1 minute red, the next minute green, maybe some sharp spikes in between. The 1-minute chart shows the struggle, while the 5-minute chart compresses it into a single bar. Now let's zoom out instead of zooming in. This is 15-minute chart, meaning each candle represents 15 minutes. What we see is price climbing higher for the first 3 candles, and in the 4th candle, sellers step in and try to push it back down. But when you look at the 1-hour chart, it tells a much simpler story. The hourly chart compresses all that action into a single candle, and what you see is just one green candle with a rejection wick at the top. That small shadow or wick at the top represents 4th candle in the shorter time frame. This is why timeframes matter so much. A bullish 5-minute candle might look powerful, but on the 1-hour chart, it could just be a small bounce inside a bigger downtrend. The key idea is simple. Candlesticks don't tell the full story on their own. The meaning always depends on the time frame. Beginners often get trapped by watching short charts and treating every candle as a major signal. But when you zoom in and out across different time frames, 1 minute, 5 minute, 1 hour, daily, you start to see the real story the market is telling. Now that you've picked your time frame, it's time to meet the 3 main characters of our candlestick story. Each one is a single candle, but together they reveal the emotions of the market. You'll hear their famous names, but what really matters is the story they tell. First, we have the strong move, the story of conviction. You'll know it when you see a long, solid body with almost no wicks. This shows buyers or sellers were in complete control from start to finish. If it's green, buyers dominated. If it's red, sellers crushed it. The most famous example is the Marubozu, a candle with no shadows at all. It's pure momentum, pure control. Next, we meet the Indecision, the story of hesitation. Here, the candle has a small body with long wicks on both sides. Neither buyers nor sellers could win the fight. The market is pausing, uncertain. The classic form of this candle is the Doji, where the body is just a thin line. A close cousin is the spinning top, where the body is slightly larger, but the meaning is the same. Confusion, a stalemate, and a warning that the trend may be weakening. Finally, let's talk about the Rejection, the story of a failed attempt. This candle has a small body, but one very long wick. The market tried to move strongly in one direction, but it was slammed back. Picture buyers pushing price up, only for sellers to overpower them and close the candle near the low. That's called a shooting star, a bearish rejection at higher prices. Flip it around. Sellers try to dump the price, but buyers rush in, absorb the selling, and close the candle near the high. That creates a hammer, a bullish rejection of lower prices. If the same shape appears at the top of an uptrend, we call it a hanging man, often a warning of bearish reversal. Here, the recovery shows buyers are still active, but the aggressive selling is a first warning that bulls are losing control. In all 3 cases, the candle's wick should be at least twice as long as the body, and the body can be either red or green. All these candles are early signal, not a confirmation to enter a trade. Now that you can recognize our main characters, this is where things get really interesting. A single candle is a word, telling you about one moment in time. But when 2 or more candles appear together, they form a sentence. You start to see a real narrative unfold, a story of power shifting between buyers and sellers. Let's look at the most important candle stories you'll see on any chart. The most dramatic story is the powerful reversal. This is a tale of a complete takeover. Picture this. You see a solid red candle. The story is clear. Sellers are in control and have pushed the price down. But on the very next candle, something incredible happens. The price opens, and buyers step in with overwhelming force. They drive the price up so aggressively that the new green candle completely swallows or engulfs the entire body of the previous red candle. Think about the sentiment here. The seller's victory was completely erased in one period. This isn't just a small win for buyers. It's a statement of dominance. This powerful 2-candle narrative is famously known as a bullish engulfing pattern, and it signals a potential change in direction from down to up. The same story can happen in reverse, of course. A solid green candle followed by a massive red candle that engulfs it is a bearish engulfing pattern, a clear sign that sellers just seized control from the buyers. Next, we have a simpler but equally important story, the confirmation. This is the story of follow-through. Imagine you see a strong green candle, a Marubozu, showing a burst of buying conviction. What does the next candle do? It's another solid green candle, pushing the price even higher. This is the market telling you that the buyers who were in control are still in control. There's no hesitation. The momentum is continuing. This sequence confirms that the current trend is healthy and strong. It's the market giving a green light to the current move, showing confidence and sustained pressure in one direction. Finally, there's the story of the warning shot. This narrative signals that a strong trend might be running out of steam. It starts with a long, powerful candle, let's say a green one, showing a strong uptrend. But the very next candle is a small, indecisive one, like a spinning top, and its entire body is contained within the range of the previous candle's body. What does this tell us? The market went from a full sprint of conviction to a sudden, hesitant pause. The buying pressure has evaporated and been replaced by uncertainty. While it's not a full reversal yet, it's a critical warning sign that the momentum is fading. This pattern, A small candle tucked inside a larger one is known as a Harami or an inside bar. Think of it as a yellow light, advising you to proceed with caution. So we've learned to read the words and the sentences that the candles form, but a sentence can have a completely different meaning depending on where it's spoken. This brings us to the single most important rule in reading a chart. Context is king. The story a candle tells is only truly powerful when it happens at a specific, important location on your chart. Think of it like real estate, where the mantra is location. A powerful bullish engulfing pattern in the middle of a random choppy chart is interesting, but not very reliable. But that same pattern happening at a critical price level, that's something you need to pay very close attention to. So what are these critical locations? They are called support and resistance. They can also be broader areas like demand and supply zones. Support is a price floor. It's a level below the current price, where buyers have shown up in the past to defend the price and push it higher. Imagine it as a trampoline. When the price falls to the support level, it has a tendency to bounce. Why? Because traders remember this level. They see it as a quote price and are ready to buy there again. Resistance is the opposite. It's a price ceiling. It's a level above the current price where sellers have historically stepped in, overwhelming the buyers and pushing the price back down. But remember, the market isn't always precise. That's why it's often better to think of these as support and resistance zones, not razor-sharp lines. Now let's widen the lens a little. This is where demand and supply zones come in. A demand zone is an area on the chart where buying pressure has been so strong in the past that price shot upward from it with momentum. When price revisits that zone, buyers often step in again, making it a high probability area for a bounce. A supply zone is the mirror image, an area where sellers once flooded the market, driving the price sharply down. When price comes back into that zone, sellers are likely to defend it again. Here's where the magic happens. You combine the candle stories with these key levels. Picture a stock that has been falling for several days. It's approaching a known support level, that trampoline. Right as it touches that level, a Morningstar candle prints, showing a strong rejection of lower prices. What's the full story now? It's not just a random bars. It's a story of sellers trying to break through a known buyer stronghold, and the buyers winning a decisive battle right at their line of defense. This combination gives you a much stronger signal that the price may be ready to bounce. Let's look at the opposite. An asset is in a strong uptrend, but it's getting close to a known resistance ceiling. Just as it hits that ceiling, a evening star pattern appears. The narrative is powerful. Buyers were confident, but they ran into a wall of sellers exactly where we expected to find them. The sellers didn't just stop the buyers, they overwhelmed them. Now, let's add the second crucial layer of context, the overall trend. A trend tells you the bigger story of who is in control of the market over time. An uptrend is like walking up a staircase. The price is making a series of higher highs and higher lows. This tells you that buyers are in dominant control. They are not only pushing the price to new heights, but are also eagerly buying the smaller dips along the way. A downtrend is the opposite. Like walking down a staircase, the price is making lower highs and lower lows. This is a clear sign that sellers are in charge, and they are taking every opportunity to sell when the price bounces up a bit. Therefore, the simplest rule for trading with the trend is to look for buying opportunities in an uptrend and selling or short selling opportunities in a downtrend. So from now on, don't just ask, what story is this candle telling me? Ask, what story is this candle telling me? And where is this story taking place? When a powerful candle narrative occurs at a key level of support or resistance, you have found a truly meaningful clue about what the market might do next. You've learned the words and the sentences. Now, let's read a full paragraph from a real chart. Don't just look at this as a bunch of candles. Let's put our detective hats on and read the story that unfolded. Here we have a chart of Bitcoin versus the US dollar, and each candle represents 1 hour of price action. The first thing we should always do is find the most important location in the story. Remember, context is king. In this chart, the key location is this yellow zone, right around the $116,000 price level. This zone is where the most important battles took place. Let's start reading the story from left to right. On the left side of the chart, in early August, the price is clearly below our yellow zone. Watch what happens every time the buyers try to push the price up into this area. They get rejected. Notice the long wicks on the top of these candles. That's the story of a failed attempt. Buyers pushed with all their might, but the sellers at this $116,000 level were stronger, creating a firm ceiling, or what we call resistance. The story here was simple. Sellers were in control of this key area. But then, the plot changes. Look at this moment right here. We see a long, confident green candle, a strong move that slices right through that resistance wall. This isn't a small victory. This is a decisive breakout. This story has just shifted dramatically. Buyers have finally overwhelmed the sellers and taken control of this critical territory. Now, this is the most important part of the story. A true professional doesn't just act on the breakout. They wait for confirmation. What happens next? The price doesn't just shoot to the moon. It pulls back and comes down to test that same yellow zone again. But here's the magic. The old ceiling has now become a new floor OR support. Look closely at these candles. As the price touches the top of our zone, it immediately gets bought up, leaving behind rejection stories, candles with long bottom wicks. This is the market screaming that the buyers who broke through the wall are now defending it. The old resistance has successfully turned into new support. And once that new floor was proven to be strong, what happened? With the buyers clearly in charge, the price launched into a powerful and confident uptrend. So what did we just do? We didn't predict the future. We simply read the story as it unfolded. We saw sellers defending a key level. We saw buyers break through it. And most importantly, we waited to see them prove they could hold that new ground. This is how you read the flow of a chart. You find the key location, you watch the candle by candle battle, and you understand the story of who is winning that battle. So after all of this, you might be asking a simple but profound question. Why do we spend so much time looking at a past chart to decide what to do in the future? The answer is that a chart is more than just data. It's a map of human behavior. That support or resistance level we identified isn't just a random line. It's a point of collective memory where thousands of traders and investors made a stand, felt fear, or saw an opportunity. Because human psychology tends to be consistent, these historical battlefields remain significant. We study the past not to predict the future with certainty, but to understand how people might react when the price returns to these critical areas. And this is precisely why candlesticks are so indispensable. A simple line chart can show you the result of a battle, but candlesticks show you the fight itself. They translate the cold, hard numbers of the market into a living story. Ultimately, reading a chart is not about being a fortune teller. It's about being a student of market psychology. By learning the language of candlesticks, you've given yourself a lens to see the story behind the price and to identify moments where the odds might just be in your favor.